Well, we just heard the governor, and as I said, it's always nice when people like the governor of the Reserve Bank of India listen to humble journalists, because I was perhaps one of the very few who had called for a pause, so I may just blow my trumpet at the moment. So basically, we've seen the repo rate being held constant at 6.5%. There's not much change as far as the GDP estimate is concerned, but on inflation, he's given some surprising quarterly data, because we've seen first and second months of this first quarter, the first quarter already crossed the average is 6.4%, but the RBI estimates that Q1 inflation will be only 5.1%. So there are some inconsistencies in that. Clearly, the RBI has got rattled, perhaps a little unnecessarily, by financial stability. So there's a certain lack of internal consistency in the governor's statement. But I don't know whether our panel of experts shares that view. So we have with us Mr. R. Gandhi, former Deputy Governor of the Reserve Bank of India, Dr. Sachidanand Shukla, Chief Economist Mahindra and Mahindra, and of course our most esteemed Nilesh Shah. I think I have to read his designation, MD Kotak AMC. So Nilesh, Mr. Gandhi, as well as Dr. Sachidanand Shukla, all very welcome. Do you agree with me that this RBI's decision to take a pause was a little unexpected, given that markets had really factored in at 25 basis points? And as I said, there were very few people calling for a pause. That is one. Number two, did you find an inconsistency in the inflation estimates, particularly if we look at the quarterly numbers? Because we're already out over 6.4%. Let me go with you, Mr. Gandhi, first. How would you define your former employer, and also mine, but a long, long time ago? Mr. Gandhi.
Okay, thank you. Yes, of course, two reasons, I think, what persuaded MBC to pause. One is that globally, there is a slowing down of the growth, whether it is IMF, World Bank, ADB, all of them are OECD. Everybody is projecting slower down of the global growth. And the world trade also is likely to be muted. That's what's the latest count that we get. That would mean that India's growth story also, to some extent, can be impacted if we remain hawkish towards inflation management. So that is the first reason why I think that they thought that it should be better to take a pause, watch out for the coming data points, and then take a call. So that is one reason. The second reason is internal, domestic, in the sense that inflation is now moderating. Then their projection is also better than the last count projections. So that has persuaded them, I believe, that to take a pause. And when you take a pause, you have the capacity to make corrections quickly in the next round also. So that way, 2 months delay might not create too much of a problem. That must have been weighing in their mind that yes, we have chance to correct it in case anything happens beyond. Because the oil price again is trending upwards internationally. That is one worrying factor. Going forward, we need to watch out. And the gold reaching $2,000, that would mean that again, a recessionary trend is being foreseen by the market, in the world market. So that's why I think that I will stop here in the initial comments. Later on, I will come back. Thank
you. Well, that was Mr. Gandhi. I don't know whether you lost him. But now can I move over to Mr. Nilesh Shah? Nilesh, what are your first views from the RBI's monetary policy?
Well, Mythili, your question is asking a commentator on a slightly tricky pitch where will Sachin Tendulkar hit the ball. This time RBI had all the luxury of either pausing or hiking, and they have taken a call to pause, which was least unexpected by the market. But my feeling is that in terms of GDP growth projection, market is little below RBI. And in terms of inflation, market is little ahead of RBI. So RBI will watch data and developments and then take a final call. So I think it's like playing the ball on its merit, and RBI has all the luxury. We just hope and pray that they get the maximum run and win the match over inflation as well as growth.
Yes, but that is really a very tall order because as we know, Sachin Tendulkar is passé. Now when Virat Kohli days. So let me ask you, Sachidanand, where are you? Who are you backing?
So, Mythili, I think what RBI today has done is it's clearly told us that discretion is better part of valor, right? We are not having a death wish like the US Fed and the US economy. They keep raising interest rates violently. I mean, nearly 500 basis in just 1 year flat, right? 12 months flat. And I think RBI has been very, very reasonable in terms of the assumptions. If you look at what they've changed in terms of inflation, from the February policy, they said 5% in Q1 and 5.4 in Q2. They haven't really changed it much, Mythili. They are saying now that 5.1 in Q1, which is just a 10 basis change. Q2 remains unchanged. So if you look at the growth and inflation numbers broadly, and we should be cognizant of the fact that in the next 5 to 6 months, the base remains really favorable. And if I just take an average, it should be giving about 55 to 60 basis, depending on which month we're talking about. So I think they are not really taking their eyes off inflation, and the forecasts also seem fairly reasonable. With all the rate hikes that have been done, especially in the advanced economies, they hardly have anything to show for, right? It's really cratered growth in particular segments, and so far we are not seeing much impact on inflation. So I think the RBI has done the right thing, and I think price stability has now given way more or less to financial stability. And like I said, discretion is better part of valor, and we can wait and watch, let some data come in, and then we can then move ahead.
Well, both Sachidanand as well as Nilesh carefully avoided my question of how we're going to get that to that 5.1%, given that in the first 2 months we're already at 6.4%. So maybe we'll have to see some more magic coming in from RBI at that juncture or from the MPC, but we'll wait and see. So we're also joined by Mr. Ashwini Kumar Tiwari, MD International Banking, State Bank of India. Welcome to the show, Mr. Tiwari. And also Mr. Venkatraman Venkateshwaran, Group President and CFO, Federal Bank. Mr. Tiwari, may I start with you? At a time when all banks have been raising rates desperately on deposits in order to gain deposits, the recent changes in the budget as far as debt mutual funds are concerned, which Nilesh must be really wringing his hands over, how much of good news is that for a bank like State Bank of India with your huge network, especially in the interior areas? Does it really make a significant difference, Tiwari?
No, I don't think it makes a very significant difference. The only thing is it is kind of levelize the field between the debt mutual funds and also the fixed deposits. The fixed deposits did not have any such benefit of indexation. So to that extent, it is just levelize the field. And hopefully some of the HNI funds which were going into debt mutual funds might now come to the banks. But I don't think it's going to make a huge difference to the bank.
So I'm sure Nilesh is very happy to hear that. But my second question really, and this is something I think you will not have a different point of view, and nor do I, as far as financial stability of Indian banks is concerned. The fact that we have a large retail base and no one depositor can really cause a run on the banks. The fact that, I mean, you and I think I'm in fact longer in the tooth than you. We remember the days of Indian Bank when its net worth had turned negative, but there was not the faintest sign of a run because they knew the government of India was behind it. So the call on financial stability, was there any reason really to be concerned about it? Of course, a reiteration of the statement that financial banks are, on very sound basis in India is entirely correct. But should financial stability really have factored in the decision making, Mr. Tiwari?
So my view is that the governor did mention about the external factor or the developed market situation where some of the larger banks have come into trouble. And one of the reasons, especially for Silicon Valley and Signature Bank in the US, has been the extreme amount of rate hikes in a very short period. So this sudden or unintended impact, which was not foreseen by the regulators there, I think it is a cause for caution everywhere. And so to that extent, even though banks in India are very stable and our ratios are far more stricter than some of the US banks, in fact, SVB and other such banks were not actually regulated so well in the sense that they had been given certain dispensations in 2018. So none of that has happened in India. So that to that extent, financial stability and all is pretty good in India. But it is, as everybody else is saying, it is better to be safe and stable and watch out for what are the effects of those rate hikes which have already taken place, and then maybe take a review of all the actions the banks should need to do. Like the governor mentioned, the bank should have buffers, the bank should do stress tests. And we have been asked for all kinds of data, and we have given that data. So while we are safe, it is good to actually relook at the whole system and see, are we missing something amongst the banks or other institutions, so that everything remains stable and safe. So that is the viewpoint I think the government is coming from.
Mr. Venkatesan, were you surprised by the decision of the MPC to hold rates, unchanged? And mind you, this is a unanimous decision. That means last time we saw, 2 of the 3 external members urging a pause, whereas all the internal members of RBI and 1 external member disagreed. Whereas this time we have a unanimous decision. How significant is that, and how does it really make a difference as far as a bank like Federal Bank is concerned?
Yeah, I think in my view, yes, we were expecting a 25 basis point hike, and the pause did come as a surprise. But having said that, if you notice in the last few weeks, the central banks across the world have started changing their stance according to their own economic requirement. For example, the Australian Central Bank hiked the rates higher than expected, whereas the New Zealand were dovish. New Zealand Central Bank hiked higher than expected. We have Reserve Bank, which has chosen to pause. So we are starting to see signs where the central banks are now looking at their own domestic data, domestic economy, whilst taking cognizance of the global factors and instability. Your second point about what it means to us as a bank, yeah, we have already started seeing today the bond yields have dropped further. And the other aspect which I want to bring out is, there was a point we've reached where we couldn't continue to pass on the rate hikes. The governor did mention about private demand showing signs of slowing down. So we had reached a point where there was no further scope to kind of increase the EMIs. You have to now start increasing the amount. So it was kind of getting to a stage where difficult to pass on the rate hike. So to that extent, it's a good opportunity for us to relook at how we balance and see how we can grow as we have been growing quite well as well last year.
Okay. Nilesh, since you and I are old sparring partners, let me return to a question which I really like to pin you down on. Given the fact that the average inflation for the first 2 months of this quarter is already 6.4, are we likely, even remotely, to get to that 5.1% for the quarter as a whole?
As I mentioned, market is expecting inflation to be little ahead of RBI's projection. But as Sachidan mentioned, there is a positive base effect coming in. And if we don't get a bad monsoon, which is expected, then I think inflation number will remain under control. For us, also another watch is oil price movement. Earlier, oil price used to move based on demand and supply. Now they are moving more based on OPEC's cartelization. So oil and monsoon continues to pose a risk on inflation on the higher side than expected. But let's hope and pray that we'll be lucky. One more point, Mythili, I would like to add. When money comes into mutual fund, there is a higher multiplier effect because we put our money in bank account. There's no leakage in terms of SLR, CRR. When money comes into banking system, there is a leakage in terms of CRR. There's a deferment in terms of SLR or credit outflow or credit deposit ratio. And overall money multiplier may get impacted. I fully agree that there should be a level playing field. But banks were at a much higher risk from insurance companies than mutual funds. Debt mutual funds as a percentage of bank deposits have declined over the last 10 years. And my fear is that the money multiplier and money supply growth will get adversely impacted because of this exemption taken away.
Okay, Nilesh, we'll have to wait and see. Then maybe we will soon. I think economists will have to start rewriting their economic textbooks because they always talked about, because banks can issue checks, they're the only entities that can issue checks. There is a money multiplier which operates only in the case of banks and not with any other financial sector player. But as we can see, all of economics is being rediscovered. So maybe we'll have some new insight into that as well. But Mr. Tiwari, just wanted to ask you, as far as loan growth is concerned, Mr. Venkatraman talked about how because difficult to pass on high rates as to borrowers are concerned. So do you see credit offtake slowing down? And will that really impact inflation? Because ultimately inflation is on account of excess demand vis-a-vis supply. Mr. Tiwari.
So we haven't seen much change in the credit growth. Last 3 quarters have been really strong. The only difference is maybe in this quarter, the loan growth has come down maybe by 1% or thereabouts, but still at about 14-15%. That's pretty strong as compared to whatever was going on earlier. So last 3 quarters have been very good. We see no signs of loan growth coming down. In fact, what is also happening is that a lot of corporates, which that growth was not happening earlier in the year, but they are now coming to us because they are not able to access dollars cheaply in the external commercial borrowings and other borrowings in the forex market. And therefore, they are now whenever the refinance comes up, they are coming for the rupee loans. So to that extent, the corporate loan growth demand is also very strong. So so far, we haven't seen any moderation in the loan growth.
Okay, that is good to hear. But of course, RBI will be worried to hear that answer, though as far as the economy is concerned, that's good news. So on that note, I know, Ashwini, both you and Mr. Venkatraman have to leave because you're both practicing bankers. So thank you very much for having joined us. And we really look forward to your comments, each and every monetary policy. Thank you so much. So now I have Mr. Gandhi, whom I want to quiz on something. Mr. Gandhi, one of the factors that actually nobody has taken cognizance of in the context of financial stability is a huge impact that public ownership of banks gives. In fact, public sector banks have always been chastised and told that they don't, they're a very poor patch on their private sector counterparts, etc., etc. But is this a very potent argument for retaining public ownership because it ensures financial stability? As I said, in the case of Indian Bank, as you are familiar with in RBI Chennai, we were all there at that time, that the Indian Bank, it made no difference at all. Its net worth is negative. That means the bank was not in a position to repay its depositors, even partially perhaps. But it made no difference as far as depositors were concerned because they knew the government of India was behind it. So would this be a case really to reiterate the case for public ownership of a significant portion of banks?
Okay, thank you. Yes, India has always held the view that banking sector, there has to be a presence of public sector ownership.
I think we've lost Mr. Gandhi once again. So let me just move to Nilesh. Nilesh, the governor quoted, and here he's talking as far as inflation is concerned. He said that disinflation will take time, it will be protracted, etc. He says that we need a durable decline in inflation closer to the target. So my question really to you here is, what is the RBI's target? Is it 6%? Is it 4%? What do you think the governor really meant when he said closer to the target? Nilesh?
I think, there is that Hindi film song, Parde mein rehne do, parda na uthao. Parda ut gaya to something. I think every central bank governor is unlikely to open all their cards. This kind of parde mein between 4% plus or minus 2% gives RBI ability to juggle multiple balls from growth to foreign exchange to government's borrowing program. My feeling is that at this point of time, with reasonable certainty on growth, RBI is probably focusing on one side core inflation, which has proven a little bit sticky. Second, they might be looking at inflationary expectations by anchoring inflation around 4% rather than higher end of 6%. But at the same time, they would like the flexibility of, tolerating slightly higher inflation above 4 in case it is needed to support growth.
Okay, so now Nilesh, we know how you spend your spare time, watching cricket as well as Hindi films. So I think that is perhaps all of us should learn from that. That's why you get these, glimpse this kind of wisdom for our viewers. So let me now join on board Amandeep Chopra, President, Fixed Income UTI Asset Management Company. Amandeep, let me ask you the same question as far as, that I asked Nilesh earlier. And this is not really strictly related to this monetary policy, but how much do you think AMCs like yours, inflows into debt mutual funds will be affected as a result of the changes made in the budget? And how will this impact bank deposits? The reason why I ask you is that now that the RBI has had a pause, banks are not likely to raise their deposit interest rates. But because of changes in taxation, you might still see a flight away from debt mutual funds into bank deposits. Would you agree that that is possibly a threat to debt mutual funds? Sustained inflows you will still get, but less than before. Amandeep?
Mythili, I think, when you look at the different, instruments and investment options that are available, clearly each one will sell on its merits. And when it comes to mutual fund debt products, I think there are clearly enough reasons and benefits which an investor draws from. I don't think it's just taxation alone. Taxation at best can be at the margin as an added benefit. I think the core benefit of a mutual fund product for an investor, besides offering liquidity, offering you the propensity to have a wide range of investment option, both in terms of composition as well as the tenor for which you can say invested, are some of the key benefits which I guess will be forever in favor of these products. So I suppose while taxation at best may at the fringe change a bit of flows, especially for those investors who are largely targeting on the indexation benefits, I think the core investment philosophy for a fixed income product within the mutual fund space still exists. Now, whether there are significant outflows, I don't think so, because if you look at the growth over the last 1 year in fixed income funds, it's largely been driven by products which actually offer very unique benefits to investors in terms of timing their investment horizon, in terms of creating a portfolio of some specific issuer profile. So I guess those still will prevail, and I have no doubt in my mind that irrespective of the sort of whatever the taxation changes brought about, fixed income funds will grow. You do offer relatively higher nominal yields as well at different points in time. And the benefit of really capturing in a potential interest rate cycle is far higher in a fixed income product than you would get in a typical, a fixed tenor deposit or a fixed tenor instrument.
Sachitharan, one point that the governor kept repeating, again and again, I think twice or thrice he mentioned, he said that this stance or this decision, etc., is restricted to this policy meet alone. He wanted to emphasize that this is not the beginning of any change, reversal in cycle, etc., etc. Why do you think he was so particular to say that this is only for this meet? Is it because the MPC and the RBI is, all central banks basically bat in the dark, which is true of all macroeconomists, right? Because there are too many moving parts. But do you think at this time the uncertainty was even higher, which is why the governor and the MPC was very careful to emphasize that this is only for this meet, leaving open the possibility of a change. They might again reverse to a hike, etc. What do you think?
No, I think this is very consistent with the kind of prognosis that he's made. I mean, I think he repeated price stability with financial stability quite a few times in his statement. And if you look at what's globally, if you look at the MOVE index, right? So while equity markets haven't really reacted too negatively, but if you look at the bond side, there has been absolute carnage. We've seen this kind of volatility, and you also don't know what's hidden in balance sheets in Europe, especially the banking balance sheets in US and Europe, etc. So I think this is the right thing to do as far as RBI is concerned. Wait for some more data, wait for some more, let the dust settle. Maybe the triage that the Western central banks attempting, maybe that is successful. And then you can take a call. The problem is already core liquidity, which is, say, a durable surplus as of now. But we have elections, we have TLTRO redemptions, currency leakage. All of that can combine into a much bigger liquidity shortage going forward. So I think that's the right thing to do. And I think to your question on inflation, which you asked me and Nilesh Bhai, if I were to look at only April, Mythili, the base effect is going to shave off 150 basis points from the April number. If I look at May, it is going to shave about basis points. So I don't think that we should be alarmed at the RBI numbers for Q1 F24. So that 5.1% number that we're talking about, I don't think is going to be such a big problem.
RBI, they are probably drawing a Lakshman Rekha above which they would like to intervene in terms of market yield or currency. If I look at rupee market, RBI has allowed markets to determine the direction, but always control the volatility or the magnitude by intervention. The same approach is visible on yield side. By and large, market is allowed to set yields, but whenever it goes in excess, they have intervened to kind of pass the message. And their intervention could be verbal as well as with money. And my feeling is that it's important to play the football match the way you want to play, but it should be played within the boundary. And there will be that tussle between market and RBI. Market will try to tease RBI to figure out where they want to draw the Lakshman Rekha. And RBI will intervene at the right time to ensure that yields remain under control and they are able to achieve twin objective of ensuring government's borrowing program passes through without major disruption. And at the same time, inflation remains under control through market pricing of interest rates.
Nilesh bhai, I was wondering whether you would give me some Hindi movie or cricket this time when I ask you this question. But you move from Ramayana and to football. So I really do not know where you're going to take me next. So let me settle with Amandeep, because he sticks to, he doesn't give me these googlies. So I know where I am. But Amandeep, where do you see government yields, 10-year government GSET yields? Where do you see them, Amandeep?
Mythili, I think it would be very difficult to predict a specific level. I guess a band would be more appropriate at current levels. And I think, like we have seen, a specific 7 to 7.5 10-year benchmark spread sort of being tested in the past. I think those are the kind of levels you can still look at. You must also be, cognizant of the fact that, at this time round, RBI was at pains to keep expressing the fact that the war with inflation is not over yet. So to some extent, we can't just take the current policy pause as being something that could be sustained over the next few policy meetings as well. I think they've left that window open by stating very explicitly, one, that the stance has not changed, and two, the pause is only for this specific policy. So let's look at the data as it pans out over the next few quarters. If the data was to prove to be, with an upward bias in case of inflation, then I guess, another rate hike is pretty much out there in the offing, which means that, you could see the benchmarks really start trending towards the upper end of this corridor. We've seen them test, in March as well. So I suppose, that sort of a level would still be seen over the coming few quarters.
Yes, we live in a world of unknown unknowns. And by the time the next MPC meets, we already will have the GDP data on May 31st. So we'll have to live and fight for another day. But thank you so much, Amandeep Sachidan. And as always, Nilesh, thank you so much for making it so entertaining for our viewers. Thank you very much. It's great to have you on the panel. Thank you. And that is back to the studio.